Right, if you're watching this video, you've probably been in a situation where you're in a covered call position and then you realize that the stock price starts tanking. So you're like, yo, what the hell do I do? You've came to the right video, so without further ado, let's get right into it. So for those of you who don't know what covered calls are, I'm gonna go over it very briefly. So covered calls, there's two parts of it. The first part, which is covered. This means that you already own shares of stock. The call part of it is you selling a call option against the stock that you already own. So for example, I have 100 shares of XYZ, but I want to kind of make some more money off of this. So what am I gonna do? I'm gonna sell one call option against XYZ, so I end up receiving a premium. If you don't understand what I just said right now, check out one of these corners to actually get the full breakdown of what a covered call is, and hopefully that breaks it down to the T. Now, usually when you watch people on YouTube and they tell you what should you do in a situation where your covered calls goes bad, they usually tell you to do one of three things. Number one is just keep having the calls expire and then just sell new ones until you get eventually, get the shares called. Another thing they'll tell you is just, buy back the call, sell the shares at a loss, and just call it game. The third thing that they'll usually tell you, which I've been seeing gets a lot of traction nowadays, is basically wait until the call expires, whatever, and then sell a call that's at a lower cost basis than what you actually bought the shares for. And then that just makes no sense. Like when people present it to you, it makes sense and you're like, oh, this is a great idea. But fundamentally, zero, just lose-lose situation, bro. So what I'm going to be talking about in today's video is neither of these 3 points. I'm actually going to be talking about a fourth new one that not a lot of people use and I personally deploy on my covered call plays. This is called the Tethered Slingshot Management Strategy. So you want to end up using the Tethered Slingshot Management Strategy in the situation where this is your third run. By third run, I mean you did a first covered call, it expired, you still have your shares. You did a second covered call, your options still expired and you still have the shares. But the third run and onwards, this is where you want to use the tethered. That's a tongue twister. The TSS, let's just call it the TSS. You're gonna use the TSS on anything from the third and onwards in terms of play wise. Now keep in mind with the TSS, you want to use this strategy under two conditions. The first condition is that the indexes are actually trading higher than they were on the previous day. So this refers to the S&P 500, the Dow Jones Industrial, and NASDAQ. If you find that all three of these bad boys are trading at a higher amount than they were yesterday or the trading day before, which is Friday if we're looking at Monday, this is going to be the first decision criteria to use this strategy. The second point is if the covered call strategy that you used in the past did not get you a 4% uncalled return, meaning that the premium you received from your covered call didn't give you 4%. The first step to execute the TSS strategy is to sell a new call. Obviously, right? You only have the shares of stock. The next thing you want to do is sell a new call. Now, this isn't going to be just any type of call. This is going to be a leaps call. As you may know, leaps are when you actually buy calls that are more than a year or more in terms of expiration. But in this case scenario, we're actually going to be selling a call that has that much expiration out into the future. Now, what you want to do in this situation is when you're trying to search for this call that you want to sell, you need to make sure that the premium that you'll receive is giving you a 10% return. And whatever expiration can get you the nearest to that 10% return, you are going to end up selling that call. So for simplicity's sake, if my cost basis was, let's just say $100, and then I end up finding out that I would get a premium of $10, that's a 10% uncalled return. That means that I would sell the call that would give me that $10 premium. It doesn't matter whether this expiration is 1 month into the future, 6 months into the future, 2 years even in the future even, but you need to make sure that it gives you that 10% uncalled return. So whatever, look at your buy and asks, place the order, whatever. But as soon as it gets executed, you want to take this point of action next, which is to place a buy to cancel order at 5%. What does this mean? I'll break this down for you. Okay, now that your call has probably been executed, you've sold your covered call of 10% returns, gangway. But the second point of this management strategy is to actually buy back that call on a buy to cancel order. Right, so now that you've sold your brand new call, you're actually going to go into part 2 of this management strategy. Now there are 2 conditions where you want this buy till cancel order to fill. The first situation is if you can get an uncalled return of 5%, or if the stock price ends up hitting 25% of its current price cycle. And this is where all your technical analysts will actually love me off. But let me break this down a little bit more. So the first point where I said getting a 5% uncalled return, you might be a little bit thrown off about that because you're like, Tamer, you just told me to sell something that was at a 10% uncalled return and now you're telling me to buy it back for 5%. What gives? Well, let's be real, when it comes down to trading options or swing trading options, you want to make sure that you can get that unrealistic return of 4%. In this case, because we're going with a leaps call option, we want to try to aim for a 5% here. So what's 10% minus 5%? It's 5%. So if you end up placing a buy till cancel order for something that'll end up generating 5% total, it could actually do you some justice. I personally just always go with this part because it just makes things so much easier. I just sell the call, do the calculations, like what is going to bring me 5%, like what would I have to buy the option back at, place the order, that's it. The second type of situation is if the stock price hits 25% of its price cycle. What the hell does this mean? I'll break this down for you. So in order to figure out what I mean by price cycle, I'm just really talking about where the stock has been trading over the past X amount of time. So I'm going to show you guys a little bit of an example on the screen right over here. And what I'm going to be pulling up is the Air Canada chart on either 5 days or 1 month. It's really up to you as to what you want to look at. But what I'm going to be showing you guys over here is a 5-day chart of Air Canada. So what I identified over here was just the maximum price that it's reached within this time frame. And I've also identified the lowest that it's reached within this time frame. And as you can see, that's indicated by over here from that top blue line and then that bottom blue line. This is basically what people would like to call as a channel. And this is how we're gonna base our 25% of the price cycle situation here. Now to actually find out when it's at 25% of its cycle, you're literally just looking for when it's at 25% of, this entire rectangle that we see over here. And with some quick, mathematicals from elementary, you could end up just seeing that yellow line that I ended up putting. That's when it's at 25%, right? Once it gets to this 25%, you'll end up seeing that being reflected within your options price. Because when it comes down to covered calls or calls in general, the lower that the stock price goes, the lower that the option price goes. And when you're selling a call, this is exactly what you want to happen. So really whatever happens first in this situation, whether you can land yourself a 5% return or if you can get yourself in that 25%, because it'll likely equal the same thing more or less. But yeah, once you end up solidifying your 5% gain, or when it goes to the 25% of its price cycle, you just rinse and repeat, hoping that your shares will eventually be called out and you can get rid of this covered call position. But you shouldn't even have that mindset to begin with, because when it comes down to covered calls, you need to make sure that you're invested in something that you're comfortable with holding on a long-term scale. The last thing that you would want to do is be put in a situation where you're in a company that you don't know what the it does and then end up holding it for like 2 years while the stock price keeps going down and down. You don't want that happening. But yeah, Z community, let me know if you guys have ever heard of this management strategy before, or even some tips that you guys have used in the past that have really helped you when a stock price is tanked. But without further ado, Z community cuties, I'll catch you guys next week. Peace.